Most individuals are on the verge of experiencing a significant financial setback, and the most alarming part is that they won't even realize it until it is too late. We are currently witnessing a rare economic phenomenon, a window of opportunity that typically only appears once every decade. This is a moment where everyday people, not just high-frequency traders, Wall Street insiders, or tech billionaires, have a legitimate chance to build generational wealth. However, history shows us that the vast majority will let this slide by. This failure isn't due to a lack of intelligence or a shortage of starting capital. It happens because most people fundamentally misunderstand the mechanics of the global economy. If you look back at every major recession, market crash, or financial crisis in modern history, a specific pattern emerges. Each of these periods of chaos produced a new group of wealthy individuals who ended up significantly better off than when the crisis began. It feels counterintuitive. How do people thrive when the world seems to be falling apart? The answer is simple, but rarely discussed in mainstream circles. They didn't get lucky. They simply recognized that a financial crisis is essentially a massive, store-wide sale on high-value assets. While the general public was panicking and selling, these individuals had a strategy to buy. We are in the early chapters of that exact scenario right now. The sale has begun, and understanding what is on sale and why is the difference between falling behind and moving ahead. The psychology of the freeze. To understand why these opportunities are missed, we have to look at the human brain. When the news cycle is dominated by words like recession, collapse, and stagnation, our biological hardwiring kicks in. Our natural instinct is to enter a defensive state, to freeze, pull back, and liquidate anything that feels risky in favor of cash. While this reaction is completely human and designed to protect us from immediate physical danger, it is the primary reason why most people never achieve true financial independence. By the time the world feels safe again and the news cycle turns positive, the window has already slammed shut. The prices have corrected, the assets have rebounded, and the opportunity for massive gains has evaporated. Data from major institutions like J.P. Morgan reinforces this. They conducted a study tracking long-term investors who tried to time the market. If an investor had $10,000 in the S&P 500 from 2003 to 2022 and stayed the course, their investment would have grown to over $64,000. However, if that same investor got scared and missed just the 10 best trading days in those 20 years, their ending balance would be less than $30,000. Think about that. Missing less than 2 weeks of market action over 2 decades costs you more than half of your potential wealth. The most explosive gains almost always happen in the middle of the most terrifying economic moments. If you don't understand how these cycles work, you will consistently find yourself on the wrong side of them. How we got here. The Great Money Experiment. To see the current opportunity clearly, we have to look back at the last few years without the confusing jargon of economists. In early 2020, the global economy came to a screeching halt. Businesses shuttered, travel stopped, and the stock market experienced the fastest 34% drop in history. The response from central banks was unprecedented. They flooded the system with liquidity. In the United States alone, the Federal Reserve printed more currency between 2020 and 2022 than it had in its entire prior history combined. The money supply skyrocketed from roughly $4 trillion to over $20 trillion in a heartbeat. When you flood an economy with that much new money, the inevitable result is inflation. More dollars are chasing the same amount of goods and services, making each individual dollar worth less. Simultaneously, interest rates were slashed to near zero, making it incredibly cheap to borrow. This fueled a massive surge in spending and investing. Businesses expanded, people bought homes with cheap mortgages, and investors poured money into stocks and crypto. By mid-2022, this overheating led to the highest inflation in 40 years, peaking at 9.1%. Things that cost $100 before the pandemic suddenly cost nearly $120. The clearance sale on assets. To stop the bleeding of inflation, central banks had to reverse course. They began one of the most aggressive interest rate hiking cycles in history, taking rates from near zero to over 5% in a very short window. This move was designed to suck money out of the economy. When borrowing becomes expensive, demand drops. This cooling effect caused asset prices to tumble. Tech companies, real estate, and crypto saw massive paper losses. Bitcoin and other digital assets lost over 70% of their peak value. But beneath the surface of this pain, something else was happening. The clearance sale. Imagine your favorite high-end store having a 40% off sale. You wouldn't stand outside and cry about how terrible it is. You would go in and buy. In the financial world, the S&P 500 dropped about 25% from its late 2021 peak to its 2022 low. This meant world-class companies, those with real products, real customers, and real profits, were selling for 75 cents on the dollar just because people were afraid. This is exactly what Warren Buffett means when he says, "Be fearful when others are greedy, and greedy when others are fearful." While retail investors were panic selling in 2022, Buffett's Berkshire Hathaway deployed over $68 billion into the market. He wasn't scared. He was shopping. The 3 pillars of opportunity in 2026. If you want to capitalize on this window, you need to look at 3 specific areas. The first is the stock market. Following the corrections of the last few years, the valuations of many essential companies have returned to realistic levels. Sectors like healthcare, energy, and consumer staples are no longer in a bubble phase. One of the most effective ways to approach this is through dollar-cost averaging. Instead of trying to guess the exact bottom, you invest a set amount every month. Sometimes you buy high, sometimes you buy low. But over a decade, you capture the 8 to 9% average annual return that has persisted through every war, pandemic, and recession for the last 50 years. The second pillar is real estate. We are in a unique, almost stalled market. Home prices rose sharply when rates were low, and then stayed high even as mortgage rates doubled. This has created a standoff where buyers can't afford homes and sellers don't want to lose their low-rate mortgages. However, interest rates are cyclical. When they eventually normalize and begin to drop, the massive pent-up demand of buyers sitting on the sidelines will flood back in, likely driving prices up again. The people who find ways to make the numbers work today, buying during the quiet period, are the ones who will reap the rewards when the market heats up again. The third, and perhaps most important pillar, is personal income and high-value skills. Your ability to generate cash is your greatest wealth-building engine. In a tighter economy, companies prioritize individuals with rare and valuable skills, things like advanced sales, software engineering, AI implementation, and strategic marketing. Investing in yourself is the only investment that can never be devalued by a market crash. A study from Georgetown University highlights that specialized education and skill sets can add over $1 million to your lifetime earnings. In 2026, the cost to learn these skills online is lower than ever, making the return on investment for self-education nearly infinite. Filtering the noise. Price versus value. A common trap is assuming that because an asset's price is down, it is automatically a good deal. This is not the case. Many companies and crypto projects were vastly overvalued and deserved to crash. To distinguish between a sale and a sinking ship, you must look at value. One simple metric is the PE, price-to-earnings ratio. Historically, the S&P 500 trades at 15 to 17 times its earnings. During the 2021 bubble, that number hit 38. We were paying double what things were worth. Now, many sectors have returned to that historical average of 15. Additionally, you must look at cash flow. Does the business have a real product? Does it have more money coming in than going out? If a company relies on cheap debt and hope to survive, it isn't on sale. It's failing. Focusing on fundamentals allows you to ignore the daily price fluctuations and focus on the long-term reality. The invisible advantage, tax strategy. There is a massive advantage available to those who understand tax-advantaged accounts, such as the Roth IRA or 401k. In a Roth IRA, you invest money that has already been taxed, but every single cent of growth from that point on is 100% tax-free. If you invest $6,000 today and it grows to $60,000 over 30 years, you keep all $60,000. If you do this during a market downturn, you are essentially compounding your discount. You are buying more shares at a lower price, and all of that extra growth is shielded from the government forever. If your employer offers a 401k match, that is a 100% guaranteed return on your money before it even enters the market. Not taking advantage of this is essentially leaving free wealth on the table. The reality of crypto and alternative assets. We cannot discuss wealth in 2026 without mentioning digital assets. After the Wild West period of 2020 to 2023, the crypto market has matured. While many meme projects disappeared, Bitcoin and Ethereum have gained institutional legitimacy, with major banks now offering ETFs to their clients. However, the rule for crypto remains the same: diversification. Crypto should be the spice of your portfolio, not the main course. Most experts suggest keeping speculative assets to 5 to 10% of your total net worth. The foundation of your wealth should always be built on boring, proven, and consistent assets. The wealth system. Why systems beat willpower. The people who actually become wealthy don't have more willpower than you. They have better systems. They understand loss aversion, the psychological fact that the pain of losing $1,000 is twice as intense as the joy of gaining $1,000. Because of this, they don't trust their emotions. They automate. They set up automatic transfers so they pay themselves first before they even see their paycheck. They ignore the noise. They don't check their balances daily. They understand that a portfolio is like a bar of soap. The more you touch it, the smaller it gets. They think in decades. They don't care what the market does this week. They care where it will be in 2036. Conclusion: the choice is yours. Financial history is remarkably consistent. Every single crash has been followed by a recovery that reached new all-time highs. From the dot-com bubble to the 2008 Great Recession and the 2020 pandemic, the pattern holds. Those who stay disciplined through the scary parts are the ones who thrive. We are currently in a period of high interest rates, elevated fear, and economic transition. To the average person, this looks like a reason to hide. To the informed person, this looks like the window of opportunity they've been waiting for. The great sale is happening now. You don't need $1 million to start, and you don't need to be a genius to win. You just need to stop being a spectator, build a system, and start moving. The window is open. The only question left is whether you have the courage to walk through it.